Welcome to Smart Talk, a series of interviews with world-leading economists and thinkers. In this episode, I'm speaking with Mattie, a financial wealth planner. He has written a new insightful book, The Global Addiction to Quantitative Easing. This work is relevant to the current environment where baby boomers and millennials are facing an unsure investment future as a result of the Fed policy. In this episode of Smart Talk, we discuss Michael's ideas as to how QE will affect investment strategy in the future. QE has become the most important Fed policy of our generation. I'm Andrew Mazzone, president of the GeorgeSchool of Social Science, and this is Smart Talk. Well, Michael, we're going to introduce you in another setting where we film that separately, but for everyone, Michael Mattie, who's an investment advisor, and why we chose Michael to interview is we have one person in common in all of this is Richard Duncan. For those people who are not familiar with Richard Duncan is kind of a favorite of a number of us people, Michael and myself, who's done extensive work on financial markets modeling and has a wonderful service keeping everybody up to date. So I think it's fair to say we both have drunk the Richard Duncan Kool-Aid for background information. Well, Michael's an investment advisor who came of age, I guess, at the tail end of what we would call traditional investing. You know, price earnings ratios, earnings of a company, capital expenditure of a company, the things that I was trained in also. And the world's kind of changed, and it's a huge change. And Michael has written a book about it. I think he's captured the zeitgeist of this change quite well. That's why we wanted to discuss this with him. What it ultimately means for investing, we're going to discuss here today, but we probably won't come up with a definite answer as to what the future brings us. But I think we'll throw light on what's going on today. But Michael, why don't you discuss what caused you to transform your investment banking practice in really a dramatic way, a real mind shift that you had to go through. And I think everybody who's been in the market has to go through this. I don't know if everybody has gone through it, but why don't you discuss your vision and how you saw the change, because you actually documented the process, and very few people have done that today. So go ahead.
Thank you, Andy. Yes, it was quite transformational. I started in the business, I was hired in 1991, which, gosh, what a phenomenal time. I left the Marine Corps. I was a captain and pilot in the Marine Corps, was hired by a firm in 1991, and for 10 years, it was just an incredible time to be an investor, to be an investment advisor, and was quite fortunate. Enjoyed some wonderful relationships during the 90s. Yes, we had a bit of a speed bump, if you will, if you want to compare a speed bump in 2000, 2003 to what happened later in 2008 and 9. Got through that all right. But then 2008 and 9 arrived, and I'd be remiss to say that was quite a shock to many investment advisors that were kind of caught unaware, and some of us were reactive in many respects during the 08-09 downturn, and you do your best to try to consult with clients to steady their hand. And after you start coming out of the 08-09 Great Recession, I wasn't satisfied with thinking, gosh, we're beyond that, like I was beyond the 2000, 2001, 2002 downturn. There was something more vicious, if you will, with that downturn. And I wanted to explore the underpinning of that, which obviously led me to the Fed and the Fed's influence. Now, for many years, we all knew the mantra, don't fight the Fed. But it was more than just don't fight the Fed this time. And if our conversation allows, you'll learn that I am not a big fan of the Federal Reserve. Yes, it was necessary, in my opinion, and I write this in the book. It was necessary for them to step in when QE1, but I feel that they extended the free and easy money well beyond the point of a necessity. And in full disclosure, I put in my book that hindsight's always 20/20, so it's easy to scrutinize the Federal Reserve well after the fact. But the fact remains that even to this day, there's some concerns with that. So to answer your question, yes, 08, 09 was a pivotal time for me as an advisor, and is one that has developed lifelong relationships with clients, and I want to make sure that we are advising them appropriately for what may come in the future.
Let me interject here. I mean, we'll talk about the world before 2008. In your opinion, were the economic policies, the policy of the country, such that it led to this inevitability? In other words, we had, the speculation, the real estate speculation, the internet boom. We had the Greenspan put, where basically he said to everybody, "Look, I'll cover you on the downside. Let it roll, let it rock on the upside." Do you have any views on why he did that, or why that occurred before we get back to 2008 when things just fell off the ledge? I mean, was this inherent in the U.S. economy that he had to do this? Was there something structurally changing in the U.S. economy, let's say in the preceding 20 years, that ultimately led to the inevitability of this change? Just from my point of view, so you know where I stand, I grew up in the old manufacturing economy of the United States, and in fact, I was the CEO of an industrial company back in the day of, American dominance, no outsourcing, high wages, and of course, from my perspective, I was that up until 1994. The world changed back then in terms of we started to outsource, we started to bring cheap labor online through China. The communist world fell in the 80s, releasing more cheap labor. American companies took advantage of that, and in effect started shedding jobs here and picking up jobs in China in low-wage areas, bringing the goods in, financing those goods by credit because we were losing workers. And so in a way, there was a buildup that was foreshadowed that ended in 2008. There was a tremendous credit buildup, job loss, and a huge import deficit arising that had to be financed by somebody. Ultimately, the Japanese and the Chinese did. So that if you look back at that era, you could see the signs growing that culminated in a 2008. We just ran out of credit gas, it seems, at 2008. The question is, why did we engage in this and in effect create the conditions that caused the investment community to have to really change their way of thinking? There was no foreshadowing in the investment community at all. It basically said, the prices are up, we're kind of technical traders. We'll look at the market. If the market is moving up, whoa, that's okay. We're not examining really a long-term change in fundamentals. And as an investment advisor, I wanted to get your sense of how you looked at the preceding period, if you did, and how you confronted the 2008. If you want to elaborate on that.
Oh, absolutely. And gosh, as you're talking, Andy, there's a couple of themes coming through my thoughts. One, the world is flat. We'll talk about that as well. The shrinking of the middle class, which I touch about in my book, which I think is very sad and needs to be focused on. But I'll go back to, as I mentioned, I was hired in 1991. I really got into practice in 1992. And the demographics, I think, this baby boomer demographics was very prevalent during that time. And it just seemed as though we were coming off of very high inflation. Yields on interest rates were coming down, and it set up this perfect storm, if you will, of wonderful investment environment through the 90s, an accommodative Fed. And that unleashed the animal spirits during the 90s, and it swept us all into this new technology of the internet. And we all remember the Y2K craze. And as we're approaching the end of the 1990s, and if you didn't buy Qualcomm today, my goodness, you're going to buy it next week for $5 higher. So you better buy it today. That kind of mentality where, darn the fundamentals, you're going to buy Vertical Net and all these other .com stocks. And that took us right into the Y2K and the subsequent downturn. And yes, we did come out of that, largely due to Alan Greenspan, the maestro, the one that had his finger on the pulse, who could not be challenged. And boy, at that time, the Fed was very much a black box. If you would have interviewed people 10, 15 years ago and asked them, well, what department of the government is the Fed in? Legislative, judicial, executive? They'd be scratching their heads trying to think, and the answer is no. They were a private entity. They're a private cartel, of bankers, created by bankers over a century ago. And it's the Fed put the money that was trickling in at that time into the economy from the Fed that led to the recovery, if you will. And of course, we enhance a lot of spending. Another thing coming to mind is we're allowed to do this, and as Richard Duncan aptly points out many times, back in 68 and 71, we went off the gold standard. Yeah. Gave the Fed the ability to create whatever amount of money they wanted to support the economy. They did so prior to 2000. They put I think it was $60 billion into banks around the country to fiscal cash in case there was an ATM issue at the Y2K. But then during the tragic disaster of 9/11, they lowered interest rates 3/4 basis points, and they stimulated at that time quite a bit, both monetary and fiscal policy. And that kind of helped jumpstart the economy as it took us into 2008, 2009. And that issue was a culmination of many factors, led by, I think, Alan Greenspan and his policies.
Okay, so if we start at 2008, we have a situation where the middle class and the lower classes do not have enough purchasing power to pay their bills, and certainly not engage in real estate speculation of the magnitude that occurred back then with the funny mortgages and the banks basically issuing paper that was of low quality. So things explode. The Fed has to come in, and now they're kind of in for good. And to keep the economy going, they literally have to pump $4 trillion into the economy from 2008 until today. And they do it by buying high quality paper or low quality paper, either from banks, sometimes industrial companies, or sometimes in buying and funding government debt, and also engaging in trying to manipulate long-term and short-term interest rates. And they don't seem to be able to stop that. And it's becoming, and I think you demonstrate, it's so powerful and so awesome, this money, that the stock market essentially is being driven by it. The market is almost disconnected from the earnings of its own corporations, because the earnings of their own corporations are primarily deriving from the fact that they got access to this money, and they can either invest it overseas or they can trade in assets. But they don't seem to be finding investment opportunities in the United States per se. Now, this is a real sea change from what you would have confronted as an investment advisor in the 90s, and that I had confronted in the 70s and 80s and 90s about, earnings drive the stock market, interest rates affect the stock market. If the interest rates go up, the market's down, and vice versa. Now we have zero interest rates. Can't put them up, because you put them up, bonds collapse. So the Fed's policy lever is gone there. It has to continue issuing money. What do you tell your clients in the face of this? There's no real common sense way you can explain to your clients about price earnings ratio, the quality of the companies, because you, as yourself have demonstrated, the market is dancing to a quantitative easing and money push drive much more than they are on earnings. So how do you, from the old days, you could say, look, read Graham and Dodd, the Warren Buffett Bible on investing, and buy a company that has a niche or has a monopoly and has good cash flow and reasonable prospects. And if you had a portfolio of those stocks, you'd have gained 8 or 9% a year. Now, what do you tell your clients in the face of what you know, what you and I both know from Richard Duncan's work about this massive credit blow up all over the world? Everyone seems to be addicted to it. Nobody seems to know how to get off it. And I come to you with some money I want to invest in for the future. What do you tell me, and how do you convince me?
Gosh, the first thing that comes to mind is adhering to conservative financial strategies. There are clients that want to be engaged and try to understand the markets, and that will be receptive to a discussion of how the Fed has influenced the markets. And then there are others that have little interest. They say, gosh, Michael, you go ahead and you know my investment goals, invest as appropriate. And those are tough. I wrote the book I think as a quantitative easing 101. It's of a very basic explanatory fashion to encourage investors, especially those in or approaching retirement, to take a modicum of interest in this entity called the Federal Reserve, because it is the proverbial 800-pound gorilla in the room, and it has a significant effect on their financial future. As you're speaking, I'm thinking about the effects of the Fed. Stock buybacks were helping to drive a lot of the growth of the stock market. And yet, investors say, oh, look, the stock market keeps going up. It goes up 10% a year, does it not? And you go, why is it going up? Yes, 40 years ago, I can explain why there was a gentle nudge higher.
It's a real problem for you today, right?
Oh, it certainly is. It certainly is. But so the person that comes to me and says, gosh, I just retired. Here are my assets. The first thing is me as a student of quantitative easing of the Fed, I know that if they're not there to support, and I'm going to say the Fed globally, because we have Mario Draghi in the ECB, we've got Kuroda Abe out in Japan. China has a big influence, obviously. They had their hiccup back in August of 2015, and we saw when they tried to devalue their currency how we went into a tailspin. So there are a lot of these global factors that can, on a dime, can change the dynamics of the markets in a matter of weeks. You don't want to hide. You're not going to hide. There's no longer the 5, 6, 7% bond ladders or a 4% money market available. So you don't want to have that money stagnate. So it is very much a more difficult conversation.
Well, let me just interject here on one thing you said on the bond. Let's just talk about the bond market. I would argue, and I think you would argue also, with interest rates so low, the bond prices are very high. How could you ever instruct anyone to buy bonds today? Because if something goes wrong with with monetary policy, they do back up in the QE, they do raise interest rates. You're going to get a decimation in the bond portfolio. So, would you agree with that?
Absolutely. However, I do invest in bond instruments, inclined portfolios, instruments, ETFs, maybe some mutual funds, but to buy individual bonds, to buy that bond ladder, I agree. I don't have the ability to have a nimble reaction.
Yeah, I'd say.
Yes, and so I do invest in fixed income, in a number of fixed income. There's some that can be levered, and Build America bonds and different ETFs, and very cost-effective ways of doing that to get that a yield, and you can get a 3, 4, 5% dividend yield from some of these investments. But you need to be nimble. It's not, I'm going to buy you this investment and we'll look at it in several years, because on a dime, that the Bernanke taper tantrum back in 13, that sent yields racing in just a matter of weeks, and it had a profound effect on bond portfolios.
But essentially, you're forced to bring your clients into either the stock market itself, or I noticed that you buy a lot of like insurance type plans, fixed annuities and things of that nature. And maybe you want to elaborate on the annuity end of your portfolio recommendations as to why you've gone to that end of the market.
Oh, absolutely. That's a great point. And I wouldn't say that it's a lot. It's a portion of a well-balanced portfolio. If I'm going to invest in the annuities and get the protection that an insurance carrier such as an Allianz can provide for that 100% downside protection with a modest upside of say 3, 4, 5%, I'm very cognizant of the fees, and I don't want to be paying much more than that 1% of fee in an annuity in order to get that type of protection and income. And I won't. That's just a portion of a portfolio, but there are other ways of structuring investments to provide you with some of that downside. And I must tell you, Andy, that the investment firms are providing more and more of these type of investments because they see that we're in this malaise, and that the baby boomers do want the asset protection, but the potential for growth. And there's more opportunities out there. But you have to be very fee conscious.
Okay. All right. So you got kind of forced into the market in general, and to make your basic allocations. And how do you feel about that? We both know, we read Richard Duncan, we know that the slightest downturn in credit, all hell starts to break loose, and therefore the Fed is not going to allow that to happen. But they can't do that forever, can they? My question to you. Can they do it forever? And if they can, well, why not just have them print money forever for us and we don't even bother to work? I mean, this is a great, this is a mechanism that seems to be a perpetual motion machine. Now, we know from elementary physics that we can't have a perpetual motion machine. So where is the flaw? Where is the danger? Where would you be sitting, taking all your clients, putting them in the stock market, because it's almost a default position here. You haven't really got many other places to go, maybe real estate. We could discuss real estate as a separate asset class that at least you can get rents out of. I happen to prefer that myself, but you're sitting in a sort of Damocles. You know the deal. You know the environment. You're reading Richard Duncan's reports on credit creation, just as we are here. You've got your clients. You can only go so far on fixed instruments, because any increase in political increase where they build infrastructure, let's say, and they put a real demand on the market, it's going to raise the interest rates, going to collapse your bond prices. And you don't know, if they do that, where the where the juice in the equity market's going to be. So how can you make a living and sleep nights is my question to you.
Excellent question. And I think those of us that believe that way will gravitate towards the high quality, large company stocks that pay a dividend, which are approaching very, very high valuations, and even the utilities and the telecoms that provide those dividends or their valuations are quite stretched.
The New York Times validated your point, I think, today. Yeah, that's what everyone's looking at, that particular group of equities.
Yes, so, healthcare is attractive. You're looking at a Johnson & Johnson because of the aging baby boomers and need for healthcare. But then you've got biotech in there, which is going to give you a rough ride and no dividends. I like consumer staples, the Procter & Gamble's of the world. However, I'll go back to your comment about the money, because as you're talking, I immediately start thinking about the difference between monetary policy and fiscal policy. Okay. And I would definitely say that the monetary policy is having a diminished effect, which takes us to the fiscal policy.
Your book, by the way, your book points out the marginal, the increasing marginal effects of the quantitative easing quite well, which means that, you know, we're approaching a watershed here from an investment point of view. If we go to a fiscal policy, and it seems that we're going to have to, if we start investing in infrastructure, something that we need to do to give jobs for lots of people, and because we have an aging infrastructure, that would probably be financed by fiscal policy. If that's financed by fiscal policy, it will draw lots of people into the workforce quickly. You may have bottlenecks, you may have wage inflation, and if you have wage inflation, you will cause interest rates to spike upwards, and if we cause interest rates to spike upwards, all hell will break loose in your fixed income portfolio. So your take on a fiscal approach as opposed to mine, or maybe in sync with mine?
I would say not so fast. Okay. Because, gosh, I think a fiscal approach, which I fully embrace and I believe is absolutely necessary, because we talked about a monetary policy which is having a diminishing marginal effect and usefulness, but a fiscal policy requires politicians in Washington to work together, and as you and I probably both agree, it's very dysfunctional. I still read about some politicians that feel as though we have to go back to a gold standard, and I'm thinking, where are they getting their economic advice? And we need to be fiscally prudent. While we may want to be fiscally prudent at some point, our economy cannot stand us to be fiscally prudent. And I believe we do need to spend trillions of dollars. But that is going to take a lot of cooperation and coordination with politicians on both sides of the aisle in Washington. And I still have my reservations as to how effective that could be. In a perfect world, I think infrastructure would be just the first goal. I hearken back to the issue, that the challenge that President Kennedy made back in 1961 to put a man on the moon in 9 years, and how that unleashed a lot of investment, both from small companies, research institutions at universities, the MITs of the world, in addition to the large companies. And I think that a well-implemented fiscal plan should be focused on helping to reestablish our middle class, which has been, I think, decimated. We have the haves and the have-nots, and we see that in a lot of wage and labor statistics. But to take it one step further, which Richard Duncan is so aptly referenced, and I don't know of others, but I reference in my book, we're spending $1 trillion a year. In fact, we made news on September 30th of this year that for the past fiscal year, we added $1.4 trillion to our debt taking it up to 19.6 trillion. And you think, what did we get for that 1.4 trillion that we spent over the last year? Why not spend that $1 or $2 trillion on a really meaningful program, like focusing on, and this is where the politicians would have to guide the country, focusing on being the world's leader in nanotechnology or biotechnology or some other groundbreaking technology for the betterment of our country and mankind in general, and really unleashing those entrepreneurial and animal spirits that could cut across all social strata. That's a Herculean task, because now, as you well know, there's going to be some special interest that's going to want to voice their considerable displeasure. If it's battery technology, it's going to be maybe some type of oil or energy firm, things of that nature. So the easy way out is infrastructure, which is desperately needed.
Right.
Boy, wouldn't it be groundbreaking if we had the political foresight to put out that Kennedy-like challenge and spend $1 or $2 trillion in a very meaningful way.
Well, I would say that regardless of what's going on in Washington, after November 4th, there's going to be some kind of consensus that occurs. I mean, it's likely that Hillary Clinton will get elected. Hillary Clinton will be besieged by the left, the Bernie faction of that party, and she'll be driven to fulfill a promise of infrastructure building, and she can start doing that on a fairly significant scale without making it a major theme like solar or whatever. But if that happens, fellows like yourself are going to be immediately impacted with the interest rate implications of that jolt, even if it's not a huge jolt. So after the election, you may be walking into an interest rate rise, even though you know that if it happens, it's going to put a lot of people out of business. They can't pay off their credit card debt. They'll never be able to pay. So it's a very dangerous situation, and we're going to see the cross currents. And you, as an investment advisor, in the next 2 months, are going to have to make a Herculean judgment as to what to do with your clients. What will you do?
A Herculean judgment, also paying very careful attention to that expected rise in interest rates. There's been many famous prognosticator over the last several years forecasting the increase in interest rates. And I'm still reminded, and I check these daily, the 10-year German Bund near 2% was down as low as almost a negative 20 basis points. The Japanese 10-year JGBs been negative. They eked up into the positive, maybe 1 or 2 basis points, back down negative. The UK gilts we're down to 80 basis points. The point is that globally, we've been fighting negative interest rates. You had 25% of global bonds in negative interest rate territory.
No,
that's diminished. But that still tells me that perhaps there's going to be resistance if the U.S. 10-year, which is right around, I think, 1.74 at this particular time, moving up to 1.8, 1.9, crossing that 2% barrier, because we'll be looking at other global rates, and will that help? Will that make these U.S. treasuries look that much more attractive and attract a lot of attention? So I'm not so sure, Andy, that we're going to see this significant move. Potential, and your thought process is spot on.
Well, I'm going to argue that.
I'm going to take that wait and see.
I'm going to argue that the electorates all over the world, Europe and the U.S. particularly, are howling for relief on middle and lower class incomes. And the only way that can be done is by an infrastructure spending all across Europe and the United States, because it's the only way they're going to be able to change that. If not, you're going to get continual movements to the right, as you see in Europe, as you see in the United States. The Trump phenomenon is essentially a move to the right on frustration. So let's assume at some point in time they can't continue to leave the status quo, low interest rates, even though if they raise them, all hell will break loose on that sense. But they're going to have to move on the infrastructure for job relief in that sense. And you have to watch very closely which way that goes, because if it does move to a concerted infrastructure movement around the world to relieve the job pressures, then you will be faced with probably a movement on interest rates no matter what they do in the QEs. And therefore your clients' portfolios as a group are in harm's way. How do you handle that?
Well, you handle that by being nimble, as I mentioned earlier. I typically don't buy the individual bonds and have that traditional bond ladder, as I did back in the 90s when you had 6-7% bond ladders. So there are ways of having and we as investment advisors hate to have that short-term focus, but if you do see the trend, you do need to position your clients appropriately for that trend, and that would be reducing your exposure to fixed income, perhaps moving more into the dividend-focused infrastructure benefiting stocks. But that is not as great a concern, I think.
The stock market, if the interest rates go up, we know the stock market has been a big driver of the dropping of interest rates. They would probably get hurt quickly in the short term also. So you'd be stuck. An interest rate kill here would probably take out a lot of stock market equity in the short term, and then you're stuck with your client. So there's always the other alternative. You can put them in real estate. What do you think about that? Real estate, REITs, and so forth, as kind of a side move away from the sword of Damocles on interest rates.
Well, I would agree, Andrew. I do favor real estate in appropriate position, appropriate allocation for many client portfolios. There's different ways of buying real estate type of investments for the appropriate client outside of the assets that I manage. We frequently discuss the purchase of an investment property, perhaps a rental property at the shore, or a apartment unit that they would use as diversification in a well-diversified portfolio. Very appropriate in many respects. For those that don't have the inclination to want to own a piece of property, there are investments that one of them I referenced in the book, the resource real estate. I favor apartment complexes if I'm going to be investing client assets. I love cash flow. And I think the demographics lend themselves to a long-term favorability for the apartment complex dynamic. So with the demographics favoring that, and with a nice strong cash flow, that area of real estate is very attractive to me. But again, in an appropriate allocation.
What about your viewpoint of diversifying overseas, countries overseas, to try to, who don't have that Fed drip into our markets? Other countries don't have the QEs quite as potent as we are, and they may be more susceptible to traditional analysis. Do you personally, or with your clients, move to other countries as kind of an offset to the difficulty in reading the QE strategy of the United States? Is that a viable option for people who are investing, to look for other countries, perhaps Canada, perhaps Australia, countries, perhaps Latin America? I don't know. How do you approach that, or do you?
I do. I consider it. I am very underweight international. Have very little exposure to emerging markets. They don't fit typically my client profile of a more stable dividend-focused portfolio. As you're speaking, I'm reminded that the top 50 central banks globally since the Great Recession have actually decreased interest rates over 650 times. Yeah. On average, once every 3 trading days, there's been a reduction in a rate in some central bank around the world. It's mind-boggling. What that tells me is that aside from the big 4, big 5 central banks, there are other central banks that are certainly influencing their particular markets. Certainly a lot more for me to try to follow on a frequent basis. So if I do look overseas, Canada, Australia, Europe, it's in a very conservative and small measured aspect, and I want that dividend. And I want the large company dividend style investments. I'm not going to get real aggressive personally for the majority of my client assets.
Okay. Then let's going back to the Fed itself. I mean, you've kind of documented the incredible power and the amount of money they've created. How do you see the Fed as an actor in the next 5 years? They're going to continue to do this, or they basically run out of gas? And from your perspective, looking at your clients' portfolios, how potent do you think the Fed will be in the next 5 years in terms of your investor base?
I really like to study the Japanese central bank because they started many years before we did, and they're almost 5 or 10 years ahead of us.
Right.
And I'm thinking, gosh, the Fed is certainly going to remain engaged. There's probably going to be some type of attempts to have more political control or influence on the Fed, which they will resist strongly. And I don't feel that the Fed will ever think they're going to be out of bullets. And we saw just last week where Chairwoman Yellen did not discount the ability of the Federal Reserve System in the United States to buy equities with Fed dollars. That was a significant statement, in my opinion. Harking back, and I mentioned this briefly in my book about the plunge protection team, which was established, as best I know, after the '87 crash or downturn, where Reagan said, gosh, we need to have something to prevent that or help prevent that in the future. And 2 years later, the PPT, the plunge protection team, was enacted. Hard to get verification, and here Chair Yellen just a week or two ago says, yes, we would not discount the ability of the Fed to buy stocks, which, gosh, if that happens, unfortunately, you want to allocate very well to risk assets and to stocks. If you do have the Fed behind you, buying stocks. So they have a lot of opportunities to get creative with their theoretical printing press.
Okay. Now, one of the benefits of quantitative easing around the world is that a lot of it now is directed at retiring and buying government debt. So you're going to start seeing a reduction in debt. And at low interest rates, it's a perfect storm for fiscal policy to step up. In other words, the retiring of government debt now with the latest few QEs has been significant, and they're doing it around the world. So that if you were plotting all of this, you could almost hazard a guess that fiscal policy, especially after the November election, will probably kick in. If that kicks in, of course, the government, will like to kick it, like to start the infrastructure with a low interest rate environment. But I'm betting that everyone will jump, and that the interest rates will jump up because more people will be put back to work, at least in the short run, so that you have to be really ready, I think, to make the moves to protect your clients' portfolios from a sudden interest rate drop, even though it's clear that the pressure is downward. And if you looked at the Japanese experience by itself, it's downward for a lot longer than ours has been downward. But the United States is the key nation and keeping the system together, so that the United States can't afford to be Japan. It would do everything in its power to move things forward. And the Japanese have an aging workforce. They don't have to keep that workforce working. The United States and Europe have a relatively young workforce that's not working. So that I would argue, and I don't know if you would argue against me here, that you're going to be facing with some modest upticks in interest rates, foreshadowed by infrastructure spending, probably in coordination in Europe and the United States. Just the bet that I have, which means that your portfolios will come at a significant adjustment. Any comments on that?
The U.S. is in a very envious position of having, as I referenced, King Dollar. We have the world's reserve currency. And because, as I alluded to earlier, the world is flat, allows inflation to remain very, very tame.
Yeah,
and I would argue, and I did mention this in the book, that the Fed is probably concerned at some degree about deflation. They would like to see that proverbial 2% target. And that gives politicians and the fiscal policy measures comfort that they can use the strength of the U.S. dollar. They can use the fact that inflation is tame right now to embark on this aggressive fiscal policy while we have that window to do so. And yes, you aptly reference interest rates going up and the potential for them to be significant. We're going to keep an eye on that.
Okay.
I don't think we have much of a choice, though, Andrew.
That's true.
With the monetary policy diminishing and the Fed getting creative and getting involved with corporate bonds and maybe purchasing stocks and other alliterations, we're going to have to encourage this fiscal policy and do it while we still have this proverbial window open.
That's it for this edition of Smart Talk. For more information on this and past episodes, please go to our website, henrygeorgeschool.org. I'm Andrew Mazzone, and thank you for watching Smart Talk.